What's up, future CPAs? If you're a BS accountancy student here in the Philippines, you know the LECPA has some tricky topics. Well, today we're going to crack the code on two of them, special dividends and those profit limits from the revised corporation code. Think of this as your ultimate study hack. Let's dive in. Okay, so imagine this. Your company absolutely crushed it this year. I mean, you are swimming in cash. Profits are through the roof. The temptation is just to let that money pile up in the bank, right? But can you actually do that? Here in the Philippines, the law has a very, very clear answer to that. And that answer is a big no. Let's get into why. All right, first up on our list of tricky topics is something that loves to pop up on the board exam, the Scrip dividend. The absolute easiest way to remember this, seriously, is to just think of it as the company handing out an IOU to its shareholders. That's it, an IOU. So yeah, a Scrip dividend is basically a formal promise. The company is saying, hey, we know we owe you this dividend, we just can't give you the actual cash rate this second, but we will. And that little promise, it totally changes the accounting because a promise to pay cash is always a liability. So how do we actually account for this thing? It's like a three-step dance. The moment it's declared, bam, you debit retained earnings and you credit Scrip dividends payable. It's now officially a liability sitting on your balance sheet. Now, here's the kicker. If that IOU comes with interest, which it usually does, that interest is treated as an interest expense. It is completely separate from the dividend itself. You just account for it over time. Then, on payment day, you just clear out that liability, pay the cash, and you're done. Easy. Okay, LSCPA pro tip right here. Burn this into your brain. A Scrip dividend is a liability. Period. The interest is an expense. Do not, I repeat, do not lump it in with the dividend. That is a classic exam trap. And the amount that hits your retained earnings, it's the face value of that IOU. Got it? Okay, good. Let's move on. All right, time to level up. What happens when a company declares a dividend, but they give the shareholders a choice? They say, hey, you can take cash, or you can take this non-cash asset, maybe some extra inventory we have. Now things get interesting. This whole scenario is called a dividend with a choice of settlement. And you know, it's a bit of a headache for accountants. And here's why. You have absolutely no idea what each shareholder is going to pick. And it's that uncertainty that makes the accounting for it so unique. Because of that choice, you create something with a very fancy name, a compound financial instrument. Whoa, sounds complicated, right? But don't worry. All it means is that it's a hybrid. It's part debt because of the cash option, and it's part equity because of the asset option. You've got to account for both sides of that coin. Let's break that down even simpler. The cash option, that's your debt component. It's a straight-up liability. The company owes cash. The non-cash asset option, that's your equity component. It's handled more like a distribution of the company's own capital. The trick is you have to deal with both of these possibilities at the same time. So how in the world do you put a number on this? Well, you have to make a smart guess. You look at the fair value of both options, the cash and the non-cash asset. Then you figure out the probability, like based on history, what are the odds people choose cash? You multiply those fair values by their probabilities, add them up, and that gives you a single weighted average liability to put on your books. Okay, so we've talked about the how for some of these tricky dividends, but now we need to zoom out and talk about the how much. Because there is a huge, overarching law in the Philippines that tells companies when they must declare a dividend. This one is absolutely non-negotiable for the LECPA. And here it is. Welcome to Section 42 of the Revised Corporation Code. I like to call this the Big Wall. It is a legal barrier designed to stop companies from just hoarding all their profits forever. This is the magic number. You have to remember this, 100%. It's the critical threshold. If your company's retained earnings go over this line, you've got a legal problem on your hands. But it's not 100% of profits. It's 100% of something much more specific. And there it is, straight from the law itself. You are prohibited from retaining surplus profits, that's your retained earnings, in excess of 100% of your paid-in capital stock. The whole point is to force successful companies to either reinvest that money back into the business or give it back to the owners, the shareholders. Now listen up, because this is a detail that trips up so many students on the exam. When the law says paid-in capital stock, it doesn't just mean the par value. For this rule, you have to add together the par value of the stock plus any share premium or additional paid-in capital. That total amount is your ceiling. Your retained earnings cannot go above it. But what if you have a really, really good reason for keeping all that cash? Well, don't worry, the law gives you 3 specific escape hatches. Think of these as your official get-out-of-jail-free cards for that 100% rule. So your first card is the most common one: definite corporate expansion. If your board of directors has an actual, approved, concrete plan to use that money to grow, we're talking building a new factory, launching a new product, then you can keep the cash. But it can't just be a vague idea. It has to be a real, approved project. Second, maybe your hands are tied. Let's say you have a big loan from a bank. And in that loan agreement, it literally says you are not allowed to declare dividends until you pay them back. Well, that contract wins. The law respects those kinds of financial agreements. And the third exception is for what they call special contingencies. This means you need to hold on to that cash for a very specific and probable future event. Think like a massive lawsuit that you know you're going to have to pay, or a government-mandated environmental cleanup. It's got to be for something specific, not just a general rainy day fund. Phew, okay, that was a lot of info. Let's boil it all down to the absolute must-knows. It's time for a rapid-fire review. Seriously, get your phone ready. You're going to want to screenshot this for your final cram session. Let's go. Dividends. Scrip dividends are IOUs, which means they are liabilities. The interest on them is an expense, totally separate. Dividends with a choice of settlement, they're compound instruments. And you measure the liability by taking a weighted average of the fair values and the probabilities of each choice. Got it? Next, the RCC profit limit. The rule: retained earnings cannot go over 100% of paid-in capital. And your 3 get-out-of-jail-free cards are: 1, a definite board-approved expansion plan; 2, restrictions from a loan agreement; and 3, a special reserve for contingencies. Memorize these. And that's a wrap. We've gone from just knowing the journal entries to really applying the law. So now you know the rules and you know the exceptions. The real question is, how would you advise a profitable company? How do you help them grow without breaking the law? That, right there, is the moment you stop just being an accounting student and you start thinking like a CPA. Something to chew on. Good luck with your review.